Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Hey mate, welcome back to the show.
Hey, great to be back. How are you?
I'm very good. This is our first chat for 2022, and we're going to do 8 companies, and we're going to do them in 40 minutes. So we've got a bunch of US companies, which you'll be covering. We've got some ASX companies, which I'll be covering. So 4 each, 5 minutes. We're going to give every company a score. So we're going to give them like a grade, if you like. So out of, from A+ down to fail. I don't know if there is one of these failures in here. There might be. If I just flick through my notes that you've written, is there maybe, there's a D. So one company gets a D. So this is going to be a bit of fun. There are a couple of A's in here, some B+. I think I've been a bit more on the fence with a few of mine, but we've got a lot to talk about, mate. Before we get to that, how's life? How's 2022? I saw the new 7 investing pick you came out with for Feb.
Yeah, I mean, life is great. It's a new year, new sun, life is always good, right? Yeah. There's more volatility. There's more volatility in 2022 than 2021, but that's okay. That's life.
Yeah, there is. So has that shaken you at all, or how have you taken the volatility?
Oh, look, I just assume that there's going to be volatility. So, that's a good opportunity sometimes to buy certain things. And, again, if you're an investor, then you have to be prepared for volatility. And in fact, if you're it's a life lesson, right? We always have to be prepared for volatility because life can be pretty volatile. So yeah, it's been fine. It's not been pleasant, but it's been fine when there have been opportunities.
Yeah, and that's the thing. I think we're going to talk about one company today, which is Twilio, which is a business that I've looked at for a long while. And I saw your tweet the other day, which I'll include in the show notes. And it's one of those companies that has kind of found its stride, and it too has been quite volatile. So some really interesting companies coming out of the mix. And I think this is, as an investor that's been doing this for a while now, I think to myself, it's actually a good thing because it presents opportunities. Of course, there's uncertainty with inflation and interest rates and the economy, etc. But there is a lot to be excited about too. So if you can move past that, if you can have that thick skin and move past that behavioral kind of monkey brain telling you to run away, I think if you keep your head on your shoulders, there will be more opportunities. So, mate, we'll include links in the show notes to the latest in 7 investing picks. If you head to 7investing.com/subscribe, use the Rask code, that's RASK, you can get access to Anirban's latest picks, as well as all of those from the past. Let's jump off with one of the biggest companies in the world, a favorite of the Australian Investors Podcast, one that I own and I believe you own, which is Apple. Trades under the ticker symbol AAPL. Tell us a little bit about this, mate. Let's start the timer for 5 minutes.
All right. Okay. So Apple, it makes Apple computers, it makes Macs, it makes iPads, it makes iPhones, it makes Apple Watches, it sells services, Most likely if you're listening, you're probably listening to it on an Apple podcast. If you're doing that, that's great. We love you for that. So what did it do? What did it do? Earnings per share was only $2.10 versus, the expectation was 189 or something like that. It was up 25% year over year. Okay. This is a small little company that's only growing its revenue at 25% per year. Earnings per share at 25% per year. Revenue was $124 billion. 124 billion. It was significantly beat its estimates. So up only 11% year over year. How does that happen? That your revenue grows 11% and your EPS grows 25%. Well, some of that is operating leverage. Some of that is share buyback. Gross margin went up. That is very, very interesting in an environment where things are more costly. I would have thought gross margins would actually compress. Gross margins went up. They were very high, 43.8%. A couple of things I'll point out very quickly. Installed base of Apple devices is 1.8 billion, 1.8 billion, not
Mhm.
million, 1.8 billion. Growth was pretty broad-based across all categories. Another number I like to quote, people forget this, but as Apple is a services business too, they had 789 million paid subscriptions on their platform. That's up 165 million in just last 12 months. That is just unbelievable. Services gross margin was 72.4%. What is really interesting is just 3 years back, the services gross margin was 62.8%, right? So that is a phenomenal leverage that is showing through in that business. Services is now a north of $70 billion annual run rate business, growing about like 24%. That is the size of Fortune 50 company. Fantastic business. One of the things to watch is Apple doesn't spend a lot on R&D compared to some of the other companies. Does not spend a lot on CapEx as well.
So your tweet about this.
Yeah. Think about the efficiency of this business. It can generate the largest amount of revenue possible through very careful spending of money. I love that. I'll give this a grade A+, and I think I did it under time.
Oh, you did it very under time. Yeah, I think, well, let's just talk about it. Apple is one of the big tech stocks, one of the FANG stocks that's just powered ahead. We've seen some of the businesses falter. One of them we'll talk about in just a minute, but it's been impressive. And you know what I think is really impressive, we didn't really get to it there, but the Chinese segment, the Chinese business is actually growing incredibly well. Whereas a few years ago, there was a lot of tension, obviously, when Donald Trump was president, and trying to get product in and out of China and privacy and source code, all that sort of stuff. But now it's taking off, and it's still seen as the premier brand in China, which is a massive market that it's not untapped, but it's a huge, huge growth market for the business over the next decade. So not just on the hardware side, but also on the services side. So yeah, I mean, I'd agree with you. I own shares. We're in the presence of another bull here. So we're both pretty keen on this business, and we both have owned it for a while. So A+ for Apple, I like it. And if you need to know the ratings or the scores or the grades that we give the companies, we'll put that in the show notes so you can glance down at your podcast player if you want to find out what they are. So the company, we're going to shift gears completely. We're basically going to go from sixth gear, probably down to first in terms of the market cap spectrum. And we're going to move to a company called PlaySide Studios, which is a company I've been tweeting about this past week. PlaySide Studios is an Australian AAA rated game developer. So what they do is they create games mostly on mobile, but also on cross-platform now. And that's typically games that are kind of like the kids games, if I kind of generalize, although not a lot of kids play them because you have to pay for them. So basically the business model is twofold. You have them creating their own games, which is called original IP. And then they do this work for hire stuff, which is where they might work for Facebook, or more recently, they announced a 10-month deal with Activision Blizzard. And so they kind of have both sides of this business. The work for hire keeps the revenue coming in the door while they create their own games and launch their own titles. We recommended PlaySide a while ago here at Rask, but also I mentioned it on the podcast. I mentioned it, and I shared the interview with CEO and co-founder Jerry Sackers. And so what's happened in the past week? Well, PlaySide Studios in, I think it was 2019, decided to buy a franchise of, think of it just like character sets. It had some games, it had some videos. And if you're from Victoria, as I am, on the train system, the metro train system here in Melbourne, you would have seen these little characters that look like beans with arms and legs, and they would always be shown dying. So I know it sounds grotesque, but there might be one with bullet holes in it, another one that's cut in half, whatever. And the idea was to improve safety on trains. So it's kind of a catchy thing that could appeal to young people in particular, but also just catch the attention of everyone. Anyway, this brand that was created for the metro train system kind of died. And it's funny because it's called Dumb Ways to Die. And Jerry Sackers recognized this, and the team at PlaySide recognized that this brand has a lot of assets in it that they can use across TikTok, Instagram, YouTube, etc., to drive awareness for other things that they're doing. So they could take that, basically that creative IP, and now they've since turned it into 10,000 different characters, which they are going to create into a game in 2023. And the basic idea is this. PlaySide bought the Dumb Ways to Die franchise for, I think it was $2.25 or $2.5 million. If I just get these numbers up, let's have a look at this. Yeah, so $2.25 million. And it actually was only last year, so 2021, my mistake. And what they did is they have since taken those 10,000 characters and turned them into NFTs, non-fungible tokens, on the Ethereum blockchain. And basically what they did is they said to all of their users on Discord and on social media, you can come and be part of this NFT minting, so where they create the NFTs, and you can buy your character effectively, and you can become the digital owner of that character. And then when the game is developed, it's basically becomes your skin and your avatar in the game. And the average selling price of these was around about $1,000 US. And they ended up selling about 7,700. A couple of thousand actually, what actually happened. So they made about $8.4 million, and the share price went up like 30 or 33% or something. And what actually happened is 2,000 of those NFTs were kind of like, they said they were going to pull up the sale at 7,700 NFTs, but somehow the final 2,000 or so got minted anyway, and they were purchased dirt cheap. And so the company had to buy them back to make good on its word to its users. And so it bought those back. And so it had to make two ASX announcements, one saying, we just made $8.4 million. And the other one saying, we just had to buy them back, buy some back for about 500,000. Now, I know I've gone on for a bit of a time here, but this is a really unique case of a company on the ASX selling a digital asset on the blockchain, which is still a kind of gray area for a lot of regulators. And they've basically returned the value of their purchase of this franchise fourfold from one NFT offering. And they also, I'm led to believe, they also get recurring payments from secondary market sales of the NFTs. So that's a lot for people to digest. You can jump onto Twitter and you can learn more if you want. But yeah, I'd give it all of the shenanigans, probably like a B or a B+, just simply based on the fact it hasn't been done before. There are a lot of critics to this, what they've done, but there are a lot of people who think that this is a really interesting way to drive awareness for a new game and get players to effectively buy in by purchasing their characters up front. So they've taken this 8-point-whatever million, and they've now announced that they're going to hire 20 developers to work on the game. So that's PlaySide, that's NFTs, and I went way over time.
Oh, well, that sounds fascinating because you basically got paid for hiring people. That's actually fascinating. Fascinating. It's fascinating.
Yeah. So they basically, it's like they crowdsource the development, and in return for people crowdsourcing it, they effectively get their own skin or their own avatar in the game, so that they can be unique in that world, that Beanland. So yeah, it's a fantastically innovative thing. I don't know if it's necessarily something that for some people don't really like it because they think it's kind of like a bit artificial in terms of what do you actually get and are the prices transparent, so on and so forth. Anyway,
and is it repeatable?
That's it. Yeah, that's it. And I've questioned that separately for our members. But yeah, that's PlaySide Studios, PLY on the ASX. We're going to move back to the US to Google or Alphabet with the ticker symbol GOOG. Mate, over to you.
Yeah, so we went from small to, again, really large. Google had a fantastic report. Earnings per share was $30 and roughly 70 cents, $30.70 versus expectation of somewhere around $27. So that was a significant beat on expectations. The reason we talk about beat is because a lot of times the share prices actually move based on whether you beat or you missed those expectations that analysts had. Revenue was $75 billion, which was super solid. YouTube, they've started breaking this out. YouTube advertising revenue was about $8.6 billion, which is again solid. And revenue growth at cloud. Now, this is the thing to remember here is that when they talk about Google Cloud, this talks about the Google Cloud platform plus Google Suite of online services that they offer. That was about 5.5 billion versus expectation of about somewhere around 5.47. Again, handy beat. They spent about 13.4 billion versus expectations of 12.8 billion. This is not a good beat. They spent more on traffic acquisition costs, which is basically the amount that they pay to get in front of leads. So, for example, they pay Apple to be the default search engine or the preferred search engine for on say Safari. So there are other payments that they make to other people to just get in front to acquire data. Overall, I think this was a fantastic report. So when you look at the 5.54 billion for the cloud, assume 80% of that is actual cloud platform, GCP. That's pretty solid. That puts it at about a, like 16, $18 billion revenue run rate per year, growing at faster than the overall cloud business. The overall cloud business grew probably 45%. This maybe probably grew at 50%. They don't break it out. That is fantastic. The key number that they did tell you is they have a $51 billion of backlog. This is revenue that they are going to book in the future. 51 billion, most of it is because of the cloud and cloud services. That has increased 70% year over year. So that tells you something about, a lot of revenue to come in the future. The other takeaway for me was, there was another takeaway. They had 65% year-over growth in the number of cloud deals worth 1 billion. Okay. Now, the one key takeaway for me, looking at all sort of the cloud results or the big cloud provider, the internet as a service or infrastructure as a service providers, was that all of them saw significant growth on the cloud, which basically means that if you have a SaaS business that you're looking at, those should also be growing, because a lot of those SaaS businesses are actually running on top of these cloud providers, so GCP or Azure and things like that, right? So if the underlying platform is growing, then you would think that, software that's running on top of those are also growing. If then your software company does not grow, then the problem really is with your software company, not with anything else, right? Because it looks like there is secular growth. Yeah. So that's, I think I would, with a little bit of holding my heart, give Google an A+. I will make another observation that is not actually on the sheet. I think for the longest time, Google's PE was ahead of Apple. I think only now Google's PE has actually dropped below Apple's. I would call that bullish for Google because you have a fast growing business that's actually at a lower PE than Apple. So that's something to keep an eye on. And Google has announced a 20:1 stock split, and that's it. That's it.
Yeah, I think that stock split is going to open it up to a lot of investors who don't want to do their, those partial purchases and whatever, and they actually want to own their own stock because, I know a lot of our members that are new to investing want to own one of the companies that they know really well, which is Google, but they couldn't buy a whole share. So, it's a great business. I own shares in it, and I was really interested because when you did your notes for the episode, you actually reminded me of this, that there was 65% year over year growth in the number of cloud deals worth over $1 billion, and based on the rhetoric,
million dollars.
Sorry. Yeah. So when I was listening to the calls, and based on the rhetoric from the last few years from the team, there has been a huge increase in enterprises looking at GCP for analytics and for those deep integrations where they could go to AWS or Azure, sure, but GCP has kind of found its place in the market, and it's really interesting. So it's really interesting to see how fast they're growing. Of course, the other two, the two beasts being Azure and AWS, are still growing really fast as well. But I think the other takeaway that I had from Alphabet was the YouTube revenue. I thought that was quite unbelievable. We have always known that it's a massive platform, but if they could do something like they've done with YouTube with Google Maps or something like that, I mean, there's even more growth yet to come. I think if I could have one kind of, I guess, cautiously optimistic statement, it would be that a lot of the companies that I'm seeing, a lot of the online retailers, e-commerce businesses, etc., are saying that the shift with the iOS privacy changes is actually leading to a lower ROI for their marketing budgets. So I don't know how that will fare for Google, but incredibly resilient business. Sorry, that was your company, not mine, but I just love it, so I had to say something. My next company, I'll be quick, and I think it's the second biggest company by market cap in Australia now after BHP's reunification. So CBA is Australia's big bank, and it reported these results. So operating income was up 2% to 12.21 billion. Statutory net profit up 26% to 4.76 billion. Cash net profit, which excludes a few things, up 23% to 4.75. Net interest margin was 1.92%, which was down 14 basis points. There are some swaps and some wholesale market stuff in there that affected that. And the interim dividend, which is one for the franking credit fans, was up 17% to $1.75 a share. I'll give it a grade of a B+. If we exclude the loan impairment expense, so the benefit that the company or the bank got from lower impairments, impairments being, for bad loans and those types of things, the operating profit was up 4%. which is still a pretty strong result. But I guess the declining net interest margin is a sign of concern for some investors, particularly as interest rates globally fluctuate, the yield curves start to change in bond markets, etc. CBA, just for people that don't know, CBA's capital position is actually pretty strong. It exceeds, APRA regulations. It exceeds even most international regulations. It's got a lot of deposit funding. It is also, I guess, the leader in technology. So it also runs a very lean business. And I guess just overall, it's important to understand that in a rising rate environment, we'll probably see more impairments. If interest rates do increase on home loans, we'll probably see more impairments, which will then lead to lower profits on that line item. So the guys at Rask Media, both Jazz and Lachlan, they've covered these results pretty well. So if you want to go back and you want to look over the last few years, what they've done is they've actually excluded the impairments. So you can see kind of how the business is growing without the impact of those accounting measures. But overall, CBA's result was pretty strong, a B+, probably the net interest margin is a weak spot. And the volume growth, aka the amount that they're lending, was better than the market average. So some pretty strong results all around from CBA. If you like your dividends, I think it's on a dividend yield north of 5.5%. So that's CBA, B+ from me. Number 5 is a company called Twilio. Trades under the ticker symbol TWLO. Mate, fascinating company. I think it's worth an introduction to this business. We've talked about it briefly, but not too much. So maybe you can tell listeners, particularly those non-technology folk, what this actually does.
Yeah, so very quickly, Twilio is basically, you can think of it as a sort of communications as a service platform. So assume that you are a business and you want to send text messages, when an order is received and you've paid for it and is now on its way and things like that. You can enable those text messaging services using something like Twilio. Or when, if someone, like say, a DoorDash driver wants to call you, they want to call you through a generic number, not through their phone, they can enable that sort of communication happening, a voice communication happening via using a Twilio. So Twilio basically provides APIs or application programming interfaces that allow developers to build tools to do communications, right? Then Twilio acquired a company called SendGrid, which basically is an email marketing company. So it gets into this marketing angle of sending out emails for, whether it's for, your e-commerce sale has gone through. Now it's, it's on its way, it's on transit. Now it's going to be delivered by this, all those sort of things. So, marketing communications and follow up using emails. Then it acquired a company called Segment, which is basically about customer data management, right? And all of these three things nicely fit together to sort of change the Twilio story from not just being a communications as a platform company, but to being an enterprise customer data company. Why is this important? This is important because of sort of changes in privacy regulations, especially as you mentioned a few times, iOS changes to privacy, which means tracking is very difficult, which means it's more expensive to acquire customers, therefore, or reacquire customers, right? So if you have a customer, you might as well keep that customer, engage with that customers. Engaging with your customers is sort of the story that Twilio is all about. And that's centered around the Segment data platform that they're building. So that's it. It's a company that has undergone a few transitions, and this is undergoing this other transition. It's a pretty large company in terms of revenue run rates. If you think about it, it reported about 840 million in revenue this quarter. The Q4, that puts it at a $3.2 billion run rate. It significantly beat its own guidance for revenue and also the analyst expectations. Still loss-making, which you would wonder, well, how does a $3.2 billion run rate company actually print losses? That's because communications as a service is a lower gross margin business. So it's a gross margin on those things that's pretty low. So Twilio's overall gross margin is about 54%, which basically means on a gross profit basis, this is about a $1.5 billion gross profit business, and they have been aggressively investing for growth. So it's a relatively sticky though, if you think about it, and it has high dollar-based net expansion in terms of people who use it actually tend to use more over time. So the company is now at a sort of a stage where it should be able to scale. They have said that 2022 is the last year where they will be printing basically an operating loss, and they will tip into operating profitability in 2023 going forward. They're sort of advising the market that they should be seeing 30% plus revenue growth for the next few years. I think they can handily do that and probably beat that because their organic growth has been around the 40% mark for some time, and there's some acquisitions that are driving it. And then we'll see the mix of services change over time from just messaging to these applications that have higher run. It's a developer first company run by a co-founder and CEO, Jeff Lawson. Really interesting company, sort of forward thinking and really well placed given the headwinds caused by privacy regulations and privacy changes in architected by Apple, and probably what Google is going to do in terms of antiquating cookies. That's going to change the game in how sort of people advertise. So advertising might become a more brand centric instead of targeting and following people around, which works well for things like Google, because search is an intent. You advertise your intent, right? So you can therefore you can surface up ads based on that intent. That's an advantage that you have if you have a search engine. But many customers would, enterprises would want to actually work closely with using Twilio's tool. So Nike, for example, is a customer that has done really well using their tool. So I really like this company. It's pulled back a lot because it was a big COVID play to some extent, because messaging was important, but that doesn't mean that messaging has disappeared. And they've given a pretty solid, Q1 guidance, inclusive of, the acquisitions they've made, somewhere around the 45 to 47% growth. They'll probably beat that. So I really like this company. And I would not give it an A+, but I'll give it an A for solid execution and a focus on developers.
I really like that the way you frame that, because, and particularly, so just to rewind what we meant, what Anirban meant there on intent, is basically on Facebook, your ads that would follow you around because they would know what you've been looking at. Whereas they don't really have a native search engine. You don't really plug into Facebook new hairdryer, but you would do that on Google. So then when Google reads that, they know your intent instantly. They don't need you to do things on the platform to figure out what you want. So that's why a lot of advertising dollars are going. I think that's really interesting. And then things like retargeting through a platform like Twilio are going to become more important, right? Because if you know someone is a customer or had intent, like let's say they put something in their shopping cart, but they didn't go through with it, you can then send them an email, or you could send them a text message if you've got that information, which becomes more important for marketers to re-engage. So it's a really interesting business, and one I followed quite a bit. We actually use SendGrid to send our transactional emails at Rask. It's a really interesting company, and it's also important that you pointed out that it's developer first, whereas say a company here in Australia called Whisper might be a bit different to that. You can actually write all your own code in SendGrid and do different templates based on what different customers do. So it's a really fascinating tool with APIs and all that. My company is a company called Nanosonics. It didn't actually come out with its results. That's, I think, next week, but it actually came out with a trading update, and it also came up with an operational update, which sent the shares down 16% on the day. So for those that don't know, Nanosonics trades on the ASX under the ticker symbol NAN, or not another number. If you're a developer, that's what you'll remember. Nanosonics does something that looks like a microwave. So it goes in a hospital and it disinfects ultrasound probes. So a radiographer would put the ultrasound into this microwave looking thing. It would disinfect it with some chemicals, and out pops a sparkling clean ultrasound probe that can then be used on the next person who might be awaiting surgery. So Nanosonics makes money in two ways. It sells the machines, but it also sells the consumables, like the bits and pieces that go along with testing and maintenance, and also kind of what they call consumables, which are, it can be like the liquids and all this types of stuff. And so what's really interesting about this is that the company is it's massive in North America. So as of the first half of 2021, the business had 22,120 units. These are called Trophon units, these microwave type things, installed in North America. The next closest was the Asia Pacific region at 1,600 units. Now, what's really interesting is the way that this business had sold its devices was through GE Healthcare. And GE Healthcare had been on this long-term kind of distribution / reseller agreement with Nanosonics. And the most recent agreement that Nanosonics made with GE Healthcare was in 2017, which then came into effect in 2019 and was supposed to go until later this year, so as in 2022. However, what happened was it was released this week it was kind of put out to the market this week that deal had been pretty much severed a few months short of actually ending. And what was going to happen is GE would become more like a pass-through reseller. So Nanosonics would now have to take care of all of like the end sales and meeting with customers in hospitals, installing the units, training people, all that sort of stuff, whereas GE would do that in the past. And so this is a massive deal because GE made up so much of the sales and the distribution effort. Obviously, for an Australian company trying to sell into the US, is a massive market. But the short of it is now Nanosonics and GE are in talks to formalize another agreement, which might come into place from July 2022, but it's not going to be the same. Nanosonics talked about earning more revenue from this new deal because they will be selling direct, but also they'll be paying more out for sales staff. It's estimated that they'll have about 100 staff on the ground by the end of the agreement in North America, and the new sales will start flowing through in 2023. So the impact of this is between 13 and $16 million to revenue. So that's what they potentially forego. But they will have the direct operations staff ready to go by the end of Q4 2022. It will result in higher gross profit margins because they'll be earning all of the revenue or most of it themselves from hospitals, whereas under the old agreement, GE would take a clip. But the difference is instead of it might have a higher gross margin, but the operating margin may be lower because they'll be incurring sales team expenses, general and admin, travel, that type of stuff. The thing I guess that was hidden by this negative update was actually something that I'll just pull out here at the end, which is that the company expects to report revenue of $60.6 million in the first half of FY22. That will be up 41% year over year. So it's still experiencing pretty massive growth. And this is important to note because the company makes the majority of its money from consumables revenue, not from actually selling the unit, which is what GE did for Nanosonics. It's actually been a few years since 2019 that Nanosonics has been doing all of the consumables themselves. So the business actually makes more money that way anyway. So it's not doom and gloom for Nanosonics. It's just a transition period. I think if I could draw out one final thing before I throw it back to you is the company is facing a stiff competitor by the name of Germantech, which has this thing called Kronos. It's a new device which hasn't received all of the approvals yet, but it is a competitor to the Trophon unit by Nanosonics. Nanosonics, by the way, is also moving into endoscopy, which is another growth lever for the business from 2023 onwards. So that's an update that sent Nanosonics, one of the market darlings, down 16% in one day. I think the update was good in terms of like management were transparent. They were honest about the risks. It's not a great thing to lose a major supplier, but it does actually de-risk the business from having a concentration risk if they can pull off the direct sales channel. So overall, not a very good update for those existing shareholders, but I'll give it a B. It's kind of arbitrary, but I'll give it a B because it's not bad. It's not terrible, but it's not the best thing that people were expecting when they woke up to a 16% fall. Nanosonics, I think it went overtime.
I have a question for you. I know,
yes.
This is a speculation. Why don't you think Nanosonic isn't acquired, or do you think that because it makes sense if it's like a company like Stryker or someone that sells medical devices and has those relationships with hospitals and therefore has the foot across the door, if they acquire it, they can actually for very little delta grow this business. And is the share price fall enough for someone to lob a bid?
Well, that's the thing. It's $1.4 billion company still, and it's I'm just going off Google Finance because I don't have the numbers here in front of me. PE ratio says it's 168. That could be depressed because of COVID. So maybe it's something to do with simply the valuation of the business. But right. I tend to agree with you that the business itself is actually a really interesting business in the sense that it kind of does its own R&D. It brings out its own products, even if they do take a little bit longer than expected. It's got a really solid market presence in North America. It's got opportunities throughout the world. It does make a lot of sense to be an acquisition target. And it's, I know you've followed it for a long time. The business itself is actually a business that has, it's been around for a while and has been growing pretty steadily. Someone like that could have bought it 3 or 4 years ago for a lot less than they bought it today. So who knows, maybe we're having that same conversation in 5 years, but yeah, the only thing I can think of is valuation. So number 7, company number 7, second from last, is a company that received our lowest score for the day and for the week, which is Meta Systems, aka Facebook, trades under the NASDAQ ticker symbol FB, soon to be META. Tell us a little bit about it, mate. What did it report?
Yeah, so I mean, the revenue number that they reported was a pretty high revenue number for a company like of this, 33.67 billion versus 33.4 that was expected by analysts. It was a beat. Earnings per share, however, came in at 3.67 per share versus 3.84 expected. I think the stock took a huge hit, 20% plus, massive, 20% plus. When a $600 billion company falls by 20%, that's like $120 billion approximately. That's like a CBA plus wiped off in one day, just to put that into a context, right? So whether that happened, that's because their guidance for next year or next quarter implies that they're going to only grow between 3 and 11%. They're blaming Apple for about $10 billion revenue loss for the year. They're saying that the new iOS privacy changes is really hurting targeting. More and more people are saying, I do not want to be tracked when that thing pops in. That's not a surprise to me that people who wants to be tracked in their right mind, you don't want to be tracked. And it looks like they haven't made enough changes vis-a-vis other companies that are growing quickly in the same space, like Snapchat and TikTok. So one of the comments that Mark Zuckerberg made in the call is that they're having a hard time competing with TikTok in the short video format. They have a product called Reels. That is, it's again, one of the things I like to say in this space is if you're not innovating and producing new products, but you can't modify, nobody's going to associate Facebook or Instagram with Reels really, because that's TikTok, right? So if they had to innovate, they had to invent something like TikTok in a standalone app, not as a part of the same app, which people associate with something else. It's just how people's mindset works. And I think they have some challenges ahead, given regulation and so on. So it was a bit surprising because of their results compared with other people's results. Snap grew 40% plus this year, and they into advertising as well. But they do a more of brand advertising versus targeting advertising, which is what Facebook does. So I give it a D. Largely for a couple of reasons. One of the things, I put a Twitter poll out in which I asked, my question I asked is this the new Yahoo of the 2020s? And of course, 78% of the people, or something like that, 72% of people thought no. And I think what they were thinking is that, well, this company is going bankrupt. No, I don't imply this company is going bankrupt. It's actually not going to go bankrupt. But, people forget that Yahoo at its time, its peak of its revenue, was one of the largest software or companies' revenues at that time, around 2007 to 2008. It was then bought out by the companies, and something happened. It didn't die. It was founder run. It was started by Jerry Yang, who was from Stanford, an electrical engineering graduate from Stanford. So it's not that they didn't know stuff, but I just think that one of the issues with Facebook is this does not own its own destiny, because they're an application after all. Lots of people can develop applications. Applications can get to scale today very quickly because of virality of other platforms. So, and because they don't control the protocol stack or the technology stack, they are in many ways hamstrung by what happens elsewhere. So that's a big thing. The other thing that, so Zuckerberg has been a great capital allocator when it comes to buying things. Right. But whether or not Facebook has innovated enough within itself is a big question mark in my mind. I haven't seen them come up with the next Instagram, right? That's TikTok. They haven't come up with, they did try to buy Snap, but they didn't come up with Snapchat, right? Whereas innovation would mean that they would come up with those things and seed them and help grow them, right? That's one. People point to there being 2.8 billion people on their platforms put together, something like that, $3 billion. It's very hard to monetize those free users that you've got in the rest of the world in places like India. Advertising revenues, bulk of the advertising, the average revenue per user is all North America. If you slowly whittle that away, right? And network effects might appear to be strong, but this type of network effect can go away also very quickly. People forget that Yahoo had Yahoo Chat and Yahoo Room, and they had users, and they had email at that time. At that time, those would appear like strong network effects and strong reasons to exist, but stuff happens. So I give it a D for execution, mostly very poor execution on their part.
Yeah, I'm an owner of Facebook shares, and I got to admit it was a tough pill to swallow, because we saw like that it was foreshadowed the difficulties with privacy. I just didn't think they were as bad as what management kind of led us to believe. And I think what we've seen more recently is like this shift in power to Microsoft, to Apple, and to an extent to Google as well, and away from these pure advertising plays and businesses. Like we've seen growth in Snap and the like, but yeah, Facebook's had a younger generation or a younger demographic problem, and it's that innovation is also something that's interesting. I think some listeners wouldn't know that Facebook also owns WhatsApp and Instagram. It's not just the core Facebook brand, but the thing that has kind of caught me is that the business can't make the acquisitions, like you've said. It can't make those social media acquisitions because Facebook, quite frankly, is not very friendly with politicians and regulators. So it can't go out and just buy whoever it wanted, like it could in the past. There was actually something brought up by Matt Cochrane, your colleague, who he tweeted something which I thought was really interesting. Because of Microsoft purchasing Activision Blizzard, which is its huge foray into the gaming space, trying to monopolize basically the vertical with Xbox and cross-platform. What Facebook could potentially do now is make a bid for another game developer, like, or publisher, like say Roblox or something that's more metaversy, trying to push into that space, because it would be very hard for regulators to block Facebook if they approve Microsoft's deal. So that's something that they may be able to wiggle through, but yeah, it's a pretty tough one. It's slowing growth. Those users have been slowing, even though it is massive. So there are levers it can pull, but interesting times for Facebook and for /Meta's shareholders. The final company that I'm going to give a C+ to is a company that is well known to Australian investors. It is called Computershare, trades under the ASX ticker symbol CPU. That's easy to remember. Revenue was up to $1.2 billion, or up 4.6% year on year. Earnings before interest and tax was $157.8 billion, increasing 17%. Earnings per share, 22.7 cents, up 4.5. Interim dividend of 24 cents that was 40% franked, up 4%. The outlook for the company, which is for FY22, and it's for what they call management earnings per share, is now expected to increase by around 9% over the prior corresponding period. So there are a couple of things to note with Computershare. I'm giving it a C+. I probably could have, it's more not a reflection of the results, more a reflection of the company itself. Every time I think about, oh, maybe I could recommend Computershare to our investors and to our members at Rask, I think, how on earth would I justify, how would I come up with a thesis for this company? And basically the best thesis that I've ever heard for Computershare is interest rates are going up, therefore it's going to make more money. So, and so just so you know, Computershare is a share registries business. And what that means is if you've ever bought an ASX or any stock basically from anywhere, you would have got a letter in the mail or an email confirmation from your broker that effectively says, here's how you can vote. Here's how you can register that for the next AGM or whatever. And that comes from a share registry like Computershare, like Link Market Services, whatever. And they get paid by the companies. So the companies choose the share registry, and the registry speaks basically with the broker that you choose. And that's basically how it all comes together. And so that's traditionally how Computershare makes money. And what does that have to do with interest rates? Well, Computershare, if you receive a dividend, say from BHP, it might go through a share registry like Computershare, which is then paid to you from Computershare. So it's BHP's dividend, but it goes to someone else before it comes to you. And what happens is Computershare holds on to that money for a few days, and that's a lot of money. It can be billions and billions of dollars. So as interest rates go up, Computershare can earn interest on that money that it holds on behalf of clients. And that's substantial. So in Lachlan's article on Rask Media, he took out a quote from management that said, if interest rates increase 1% on the exposed average balances, this is from management, we currently from the exposed average balances that we currently manage, that would generate an annualized earnings per share increase of 26 cents per share. So 26 cents per share. Just to let you know, they reported in the period at 22.7 cents of earnings per share. So, I mean, that's only for the half year, by the way. But so that's a big increase in the company's earnings. The problem is when you get Computershare, in my opinion, the problem is when you get Computershare, you're going to get a bunch of other stuff which comes with it. Like you get debt, you get totally different businesses. Like you have to try and understand this. Like I've often joked that CBA shares is where capital goes to die. Computershare is not quite as bad as QBE. It's actually a really good business, but it's just got a lot going on. So it's hard to build that thesis around it. But if you do believe that interest rates are going up, you can easily see why insurers and companies like Computershare are all of a sudden getting a lot of attention. So Computershare, I'll give it a C plus. I think it was a good result. It's pretty solid. It's reasonably solid, but they report a lot of mumbo jumbo, to be honest, even for an analyst like myself. Like here's one of the metrics, which is management revenue X. I think it's market impact, management EBIT X market impact. It's just, there's a lot going on and I just can't get my head around it too easily. So C plus, good for shareholders that own it because the shares have responded pretty well, and good for you if you own it. Not one for me, but that's our 8 companies. So just to recap, what have we covered? First of all, we covered Apple, which got an A plus. No surprises there from the two of us. PlaySide Studios for its NFT offering got a B plus. Alphabet, aka Google, got an A plus for massive YouTube and cloud growth. CBA, B plus with a bigger dividend. Keep a watch on those impairments. Twilio, benefiting from the privacy changes, is a great tweet from Anirban, which you can find in the show notes. I'll put a link there. It gets an A. Nanosonics, from retreating from that GE healthcare deal, gets a B. Keep an eye on that set of results that come out soon. Meta Systems, aka Facebook, gets a D from Anirban because it's failing to innovate amongst many other things, failing to respond to iOS changes. And Computershare gets a C plus because I was put off by all of the different charts and the debt and the but all things considered, interest rates are good for Computershare. So 8 companies, we covered that in probably just over 40 minutes. Mate, this is heaps of fun. If people want to find out more about what you're doing, get your latest recommendations, where can they go?
You can always find us on Twitter. So you can find me at 7A Mahanti. You can find Owen at Owen Rask. And if you want to find out what we do, you just go to 7investing.com and you can see what we did. Lots of free articles. And if you want to subscribe, then it's /subscribe. You don't have to subscribe.
Yeah, you don't have to. There's heaps of material on 7investing.com. If you want to just learn about things like portfolio management, on how the team selects companies, there's videos, there's podcasts, some fantastic podcasts. If you want to listen to a podcast from 7 Investing, it was from last year. One of my favorite was with I can't remember his name off the top of my head, Rocket Lab founder out of New Zealand, now in the States. Fantastic discussion with Simon. So yeah, fantastic. If you want to learn more about me, you can head to rask.com.au, or we'll be back next week with more podcasts. So as always, mate, thanks for joining me.
Thank you for having me.